welcome to Online EdVantage. I'm Lisa Farmer and I'm your business professor. Please subscribe to our channel to follow our videos. Today we're going to discuss supply and demand in free markets. What do we mean by a free market? Well, free markets can be defined as markets where the seller has the ability to decide what they want to sell, as well as how much they want to produce of that product, as well as pricing for that product. So in a free market, consumers tend to send signals about what they like, how they like it. Producers pick up on those signals and as a result determine on their own what goods they would like to produce and how many. Price tells the company how much of a product we should produce. So obviously the higher price I can command, the more products I'm going to be incentivized to produce in a free market. So if something is desired but difficult to get in a free market, that tends to drive the price up until more products become readily available. So that's the basic philosophy of a free market that we're going to be discussing today. So let's take a look at pricing and use a shirt as an example. Let's say I'm a shirt manufacturer, I make shirts, and I really want to sell my shirts for $50 each. But at that price, there are only a few people willing to buy my shirts. Now, let's consider what would happen if I reduce the price of those shirts to $30 each. Based on that lower price, a lot more people want to buy my shirts. So I might actually sell more, make more money if I lower the price. So in this situation, let's just assume that we establish a price of $30 based on what our consumers are willing to pay. And that's the basic philosophy of supply and demand in a free market, that we will settle upon what we call an equilibrium price based on what sellers need to make in order to produce the good and what buyers are willing to pay. Let's talk about first our supply curve. So in a free market, the quantity of our product that we're willing to produce and sell is going to vary based on the price we receive for that. So let's continue on with that t-shirt example. So first we're going to take a look at what we call our supply curve. We're going to graph the quantity of t-shirts that I'm willing to produce at different quantities that the t-shirt might sell for. So for instance, let's say that my t-shirts are only selling for $5 a piece. In this case, I am willing to only produce 5 t-shirts. Other than that, I'm going to focus my production capacity elsewhere on products that I can sell for more. Now, let's say that my t-shirts are selling for $20 a piece. Well, now I'm willing to produce about 30 t-shirts because I do have a better margin at that point. Last, let's go jump upward and take a look at what if my t-shirts are selling for $50 a piece. All of a sudden now I'm willing to allocate my entire production capacity to t-shirts because I have a great profit margin, and now I'm willing to produce 50 t-shirts each. So as we graph this phenomenon, we're going to call this our supply curve. Let's switch gears for a minute and take a look at the demand curve. The demand curve is going to consist of the quantities our consumers will demand based on those different prices. So as you can imagine, if t-shirts are selling for $5 a piece, you are going to stock your closet with way more t-shirts than if they're selling for $50 a piece. You're going to demand more t-shirts, and that's what we are looking at here is our demand curve. So let's go back to the same example. Our t-shirts are selling for $50 a piece. Wow. I might buy a few just because I really like t-shirts, but I can't afford to have too many t-shirts in my closet. We're going to, as consumers, demand 5 t-shirts. Let's say now, take a second to look at how many t-shirts we are going to demand if the price drops to $15 a t-shirt. Wow, okay, I need more t-shirts in my closet because this is a pretty affordable clothing option for me. All of a sudden, the demand for our t-shirts is up to 25 t-shirts, excuse me. Last, let's take a look at what happens if the price of our t-shirts drops all the way down to $5 a t-shirt. All of a sudden, everybody wants to wear t-shirts everywhere they go, and now we have a demand for our t-shirts of 35 shirts. So this is what we're going to call our demand curve as we graph the demand at those different prices. If we lay these two graphs on top of each other, we can establish our market price or equilibrium price for our t-shirts. This is naturally going to be the intersection of my supply curve and my demand curve at all those different pricing levels. And if you take a look at our graph here, you can see for our t-shirt example that we have determined an equilibrium price of $25 per shirt based on our supply curve and our demand curve. I hope this video helped you. Thanks for watching, and please click on the EdVantage logo to subscribe to our channel.